Hello, my name is Aaron Rosen, your local realtor in Northern California. Today is Monday, July 22nd, and I just wanted to talk about a few things today, mainly relating to politics and macroeconomics and swings for the housing market. So, we've got an election upcoming, and there's been a lot of news. There was the attempted assassination of Donald Trump. Biden has dropped out and named Kamala Harris. So it's not my job. We're not picking sides in this, but I do see a political singularity. And what I mean by that is it's very, very hard to predict the housing market on the other side of the election. There's a whole myriad of factors that could send the housing market way up or way down. So if my clients, for example, are looking to sell their house in the next 6 months, or maybe a year, I actually recommend doing it beforehand. The potential downside in the housing market is extreme. And that doesn't mean that the housing market is set to crash. It's hard to put percentages to this, but I do think that there's a number of events that could throw things either one direction or the other. So I just wanted to go over a few little signs. I don't really want to get into exactly what this president might do versus that president might do and analyze all their policies and all that type of stuff. It's just a little too abstract and unrelatable for this. So you can make up your own conclusions about what one party or president might do versus another. I just wanted to show you some of the things that can happen when real estate changes. Okay. So here we have, Biden drops out, just kind of showing you some interesting headlines for today. Okay, so this is the average price of a new apartment across Japan. If you're not familiar, Japan had a huge, historic run-up in their stock market and all of their companies. Japan was absolutely just on fire for decades. You can see here by this chart, from the 50s all the way up to 86, 88, right around when I was born. And you can see that an apartment went from under 50,000 yen, which, let's be real, this is probably about 200,000 yen, 150,000 yen in 1956, up to 5 million yen. That is huge. And this is in Tokyo, so it didn't quite experience that everywhere. And there's a lot of reasons for this. It's not that this was just an anomaly. Japan has had a long history of electronics. Actually, after World War II, what really propelled them to a modern economy again was the radio. And that's a whole nother story. But as a result of a lot of what they did, they were flying around and giving business lectures, and people were flying to Japan to learn how companies did all this stuff. And so it just shot real estate up and up and up and up and up. So we could do 10 times. We could do the math on this, but easily it maybe went up 50 times. So if it went from all the way down here, and then the interesting thing is it crashed. Now, America and Japan, completely different places. Okay, so I'm not saying that this is going to happen to America, but because of a number of political events, there could be riots. There could be a lot of different people who contest either side of the election. We could have extremely high interest rates. We could have extremely low interest rates. There could be some sort of political, socio-economical, geopolitical disaster that sends interest rates through the roof. If interest rates go through the roof and they go back to Paul Volcker days, around 20%, housing is just going to crash. It's absolutely going to crash. If we bring interest rates down to zero again, like we did from 2000 after, I can show you a chart on this, houses are just going to soar. It's just going to shoot straight up, just like the Imperial Guard, or the the average price of a new apartment. I will get to the Imperial Gardens. So one of the fun things about this, and this is one of my favorite real estate facts ever, and I will show you now, at the height here, when real estate was at its biggest boom in, let's just call it 1988, The Japanese Imperial Gardens. If you don't know about the Japanese Imperial Gardens, it's the gardens of the emperor. So look, it's gonna be expensive. It's fancy. It has thousands of years of cultivation and tradition and all that. Regardless of that, at one point, the 3.4 square kilometer, that's not miles, 1.31 square miles, occupied by the Imperial Palace, the Imperial Palace, not just the Imperial Gardens, was worth more than the entire real estate value of California. The entire real estate value of California. Just think about that for a second. 1.31 square miles. California is what, 2,000? Let's just look up how many square miles. How many square miles is California? Okay. California is 155,000 square miles. So we could sit and do the math on that, but you just get an idea. That is what a real estate bubble looks like. That's 150,000 times more expensive on average. Well, 1.3. If we round it down, let's just say it's 130,000 times more expensive than the average real estate in California, which is amazing. So, just the capital gains from stocks and land in 1987 topped 3.4 trillion, or 40% of annual GDP. So it went way, way, way up, okay? And then you see it actually has not recovered. You see this? So from 1988, and this goes up until 2018. So that's going to be 40 years. The Japanese real estate market has not recovered from its all-time highs. So, here in California, house prices appreciated around 3.8% per year on average over the last 20 years. There has been there has been 0 periods in California where had you bought a house, it would be worth less money than in 30 years. So this is why real estate is considered a very safe investment, and that has really percolated into the mindset and the hearts of investors. Real estate always goes up. Most of the time. 99% of the time, real estate always goes up, and it depends where you are. So there's reasons why California has expensive real estate, and the short of it is Silicon Valley. There's a huge tech boom. California, we've always had something that draws the California economy, that really pulls it forward. First, it was gold. After that, we had, Hollywood, we've had the food, we've had tech. There's been a bunch of different things, not to mention the sunshine, that just keep pulling California real estate higher and higher. Does this mean that we are going to have a correction? Maybe, if a certain set of circumstances happen. I don't give this a high likelihood. Maybe around a 5 to 10% chance, but I can envision a certain set of circumstances with the elections. Let's just say that there's riots. Riots and high interest rates will pop the California bubble. So these are things to keep your eye out for. Okay. While putting this together, I actually came across another article, which is kind of interesting. Square foot in this Silicon Valley city is the most expensive in the U.S. Interesting. Remember what we just talked about, bubbles. So, let's just go through and read this. In the Bay Area, living space comes at a premium. The high cost of housing means that buyers can pay hundreds of dollars for every square feet of a home. But in a few places anywhere in the United States, does a square footage cost as much as Palo Alto. The median price for square foot of a for sale home was $1,761 in May 2024. That's high. That's really high. I get it. Again, there's lots of reasons, but just as a reference, during the height in San Francisco, maybe 2 years ago, it was $1,000 a square foot. Here, where I am in Santa Rosa, it's more like $500 a square foot. So it's triple. It's more than triple for just an hour and a half away. Maybe it's a little more. Maybe it's 2 hours. So this was more than 3 times the median price in California overall at $520 a square foot. See, that's about where I am in California here. So here it goes down to show, Palo Alto, Newport Beach, Santa Barbara. These are all very, very expensive places. So this is just showing you that while we may or may not be in a bubble, that there's certain places that are more expensive than others. Here's the question. Do you think Palo Alto is the next Japanese imperial palace? It might be. There's a couple of $1 trillion worth of market cap there for stocks. Maybe, so there's a lot of talk about having a recession, having a pullback. We've had a historic stock run in the last let's be real, the last 2 decades. Since the year 2000, all of these stocks have gone up massive amounts. The average S&P is 8-10% or something like that. And Nvidia, Apple, all these other ones have gone up, 5,000, 10,000, 15,000 or more as a percentage. So things are definitely up. And if we have a huge correction in the stock market, well, I can guarantee you that Palo Alto house prices will come down. So these are just things to keep your eye on. If you're a consumer, if you want to buy a house, then knowing and understanding when and where to buy a house can save you a lot of money. After the 2008 crash, there was one particular house I looked at. It went from $1 million to $2 million in just 10 years. So from 2008, it kind of bottomed out, and then up to 2019, it was a $2 million house. Okay, 11 years, depending on how you slice the cake there. But that means that house gained $100,000 a year, $10,000 a month. That puts you in the top 10% of earners across America. Only 10% of people make more than $100,000 a year. So, do I recommend buying a house right now? If you need a house, the best time to buy a house was yesterday, and the second best time to buy a house is today. There are other ways to hedge your bets, which is beyond my financial ability to comment on and to give legal advice, but let's just say you can Google it and find there's ways to hedge your bets, and there's things that go up in opposite when houses go down. I can say, for example, gold and silver, they went up a tremendous amount during that time. So, you can sit and do the math, and if you'd like to do the math on this, if you buy a house today, I recommend having 1 year worth of payments in gold or silver, because that will offset largely any potential risks. That's what gold and silver are for. Should you do this personally? I cannot tell you that. You should go talk to your financial advisor. Okay, so California, let's just move on. California insurance crisis, partly cooling the real estate market. One of my clients just told me that their insurance doubled, which is a big deal. It went from $1,000 to $2,000 a month. And that's quite a bit as far as their total monthly expenditures for their house. So let's just read through this and see if we can get anything interesting. Between home prices, high interest rates, tax increases, and now insurance rate hikes, the cost of the American dream in California has gone through the roof. Something has to give. Nearly 7% of all real estate transactions statewide have fallen out of escrow due to insurance crisis. That is a big deal. So Governor Newsom had some announcements around that, which you can make your own conclusions for. I actually thought that we might get Governor Newsom as either a presidential pick or maybe a vice presidential pick, and that will potentially change the dynamic in California. So these are things to look at. If there's somebody who is, I don't know who or why or how, but let's say more pro insurance, then they might change the regulations on it, or they might change, for example, the California provided insurance. Okay, let's move on. California's across the board, out from the statistic, was primarily traced to the insurance not available for over 61% of the prospective policyholders. For over 19% of policyholders, premiums turned out to be too expensive. Of the 1,843 responses from the association's membership, the 2023 annual housing market survey, 37% of respondents said that insurance premiums were too expensive, and 27% said that their client's insurance got denied. Another 35% had difficulty obtaining insurance. A third of people had difficulty obtaining insurance. Almost two-thirds represents buyer in rural areas, which are commonly adjacent to wildfire-prone land. So, some of the way in which insurance works is they actually just count how many feet you are from a fire hydrant. And some of my clients, they actually live out dirt roads, and they have their own fire hydrant that was actually installed by a water tank that's maintained by a local fire station, and that brought their insurance down. So let's just move on. Buyers are having a rough time, association economists said. In many cases, insurance companies are raising their rates 20%. It's impractical, the agents who must have more conversations with their buyer. The bigger effect is on the cost of borrowing, but this won't knock high interest rates off the pedestal. So this is just showing that we have high prices, and some of those high prices are now affecting other areas, because the higher the prices for your house, the higher the insurance is going to be. So those record high houses that are $1,700 a square foot, most houses, let's just say if you have a standard house, it's about 1,300 square feet. That's a 3-2 at $1,700 a square foot. It's going to be around $2 million. The insurance on a $2 million versus a $1 million house is going to be significantly different. So that's just kind of an interesting take on all this. These are the kind of factors that will help push the real estate market up or push it down. Right now, we actually have a lot of inventory, and if you're going to be getting insurance on that, it's going to be tough. Let's check out this next article. Me at the top here. The housing market is close to a rare buying opportunity, with prices set to drop in pandemic boom towns. So that's not everywhere. We've actually had a huge bifurcation of the real estate market, and that just means a split, like a snake's tongue is bifurcated. So there was huge places in, so during the pandemic, housing prices shot up more in some areas than others. And those are the areas that have come down the most. San Francisco, I can already tell you, it had come down 15 to 20%, if not more at one point, and now it's started to rebound up. If the circumstances provide, it could go down another 15, 20%. Do I envision it taking a 60, 70, 80% hit like the Japanese market? Under certain conditions. I think that there's maybe an 80 to 85% chance that it slides down another 10 to 15%. And then I give it, depending on the political situations, about a 5 to 10% chance to come down more than 20%. Prospective home buyers may be better off staying in the sidelines. The housing market is on its way to a rare buying opportunity, with a steep home price decline bound for key areas of the real estate market in the coming years, according to one analyst. The CEO of real estate analytics, Reventure, thinks that home prices in the South are bound for double-digit decline over the next few years. That's because the region boomed during the pandemic, during all that low interest rate. Every percentage that the interest rate goes down makes about 15% more affordability. So interest rates went from, I don't have the chart right in front of me, but they went from about 5%, let's say, all the way down to 0%. So that's just boom, 50% more purchasing power for all of those people. That's because the region boomed during the pandemic, but is now seeing waning demand and a deluge of housing inventory about to come online. He thinks, this is exactly what I said. I didn't even read this article. He thinks a 20% price decline in the region over the next few years is reasonable. So you got to remember that the 2008 housing crisis actually started in 2007 and it bottomed in 2008. It did take about 18 months for that process to happen. The real estate market is a lumbering giant, and it takes a long time for things to happen. And the reason for that is because the people and the cycle that have to buy houses, it takes time. You have kids and you need a house. This isn't an instant thing. You got to think years into the future. He goes on to say that alone won't be enough to make the housing market more affordable, but this could put some home buyers on the path to good opportunities in a few years time, assuming that the price decline continues. Mortgage rates keep falling and income in the South keeps rising. I'm not anticipating that home buyers will look at that and be like, I'm going to rush in and buy. If someone's expecting an overnight crash where everything gets cheaper and everything is cheaper to the level that they want it, that's unrealistic. Housing prices fell off the cliff during the pandemic, but that was an anomaly. That is the only time in American history that prices have gone down that much that quickly. But if someone has patience and does their due diligence, in 2 or 3 years, there will be a lot of good buying opportunities. Moments of opportunity for buyers are rare in the current market, with the majority of prospective homeowners held back by high interest rates and low inventory. Those factors have resulted in one of the most unaffordable housing environments the U.S. has seen in decades. There are ways to combat this. You can ask for lower interest rates. Buy downs are actually quite common. A few months ago, my loan originator told me that 80% of the deals that she was seeing actually had owner buy down. So there are ways to kind of chip away at this. And I also do a series, which I'll do after this, about the biggest price reductions. So you can literally just look at a house. Let's say it's $1 million house and you do all the calculations and you say, you know what, $750,000 is how much I think that house is worth, given that I have high interest rates, given the political uncertainty, and given the insurance rates. And then literally just offer them that. When I go on the market, I look for places that have been on the market for 100 days. Right now, the average, depending on the type of house, is around 18, 20, 25 days. If you see a house that's been on the market for 100 days, sometimes people have things that they have to do. They need money for bills and college, and they want to do some project for their business, or they want to move state, they got a job. All these different things. When you see a house that's 100 days on the market, start to think of why. That means that this person, there's a couple of reasons. One, the house isn't worth it, which is a whole nother thing. The other one is that person hasn't come to the emotional conclusion or logical that their house needs a price reduction. Sometimes people get a little offended at low offers. I don't care. You keep emotions out of this. I have written offers for hundreds of thousands of dollars under asking. I actually like to do it because then my clients are really, really happy with me. I was tracking my stats, and for a while, I was 12% under asking. There was some huge ones that kind of changed that, but that's great. I was literally getting people $30,000, $40,000, $50,000 off of houses that were $750,000. So it's good to write offers that are under. Never be ashamed of that. If the agent wants to call and yell, let them show their unprofessionalism. So he's focusing specifically here in Southern California. Things are different in Southern California boomtowns, he says, as those areas are coming off to end the pandemic-fueled construction frenzy. So this is a really good point. Here in Santa Rosa, there have been so many apartments that were funded and started building, and townhouses and regular houses, during the pandemic with those low interest rates. And those take time to build. Single family residence, you can build that fairly quickly in just a number of months. But if you have a 200-300 unit apartment building, or like a planned urban development that is hundreds of units, those are just starting to come through. We were just driving by one earlier. Regular apartments, they were asking $4,400 here for like $1,000 or 1,000 square foot apartment that was, okay, it wasn't luxury or anything. We drove by yesterday, and they have huge occupancy rates. I looked, the place looked deserted. There was barely any cars there. So those people are going to be crunched because they have these huge bills that are coming in. Okay, we'll just continue here. But demand in the region is now starting to sag. Home sales have stagnated in key states like Florida, Redfin data shows, with the state losing its luster as a boomer retirement haven. New homes are still being added to the market. Builders in the South have nearly 8.9 months of fresh housing supply in the works. That's not too far from the peak record in 2008, when Southern home builders had around 10.8 months of supply. So that's just pretty interesting. I've actually seen this too. When interest rates went up, the housing sales and inventory just plummeted. And now that they've kind of remained in a plateau, the inventory has actually shot up a bunch. A lot of this is about expectations, not necessarily just current prices. Okay. The result could be a steep supply-demand imbalance in the region, pushing prices lower. Demand for new homes is way down from the pandemic, and that's just intersecting. And now that's intersecting with the biggest pipeline home sales in the South that we've ever seen. That's an additional ingredient on top of what makes it already more likely for prices to fall. Okay, so the last thing that I wanted to go over today is I just wanted to watch this with you. And this is Blackstone's Gray on real estate, Biden and earnings. So let's just go through this a little bit. I might not go through the whole thing here, but if you don't know, Blackstone is a part of BlackRock, I believe, and they buy up a lot of houses. Okay. Excuse me. So I'm just going to put my headphones on here, and let's just go through this and see if we can learn anything.
Because if you looked across the business, that was really the one place that a scarcity of exit activity really weighed on fee-related earnings ultimately. The big question is, what is it going to take for exits to start rebounding in the property sector?
Well, Shanali, it is great to be with you. Just quickly on the quarter, we think it was another strong quarter because the forward indicators for the business were so positive. We were super active deploying capital in the quarter, $53 billion invested or committed, which is the busiest quarter for us in 2 years, and we raised nearly $40 billion. What I would say as it relates to the property sector, healing of a market that's been under pressure takes a bit of time. As you'll recall, back at the beginning of the year on our Q4 earnings call, and I think on your program, I said that I thought real estate was bottoming and that we would deploy a bunch of capital. And that's exactly what happened.
So, right now, during high interest rates, like I just said, prices had come down quite a bit. But interest rates had come up, which meant that the actual price that you were paying for a house had increased if you did the math. But if you had a bunch of cash, or if you were lucky enough to raise $40 billion, then you could buy houses in cash. So in the last, let's just say 6 months, if you had cash, there was amazing buying opportunities. And that's what he's talking about here. This is one of the issues of that I think is not so good about the real estate market, in that the average consumer has to pay with a loan, while usually these big companies, they can actually get better loans and they have tons of cash sitting around. I just did the other day an article about Apple and how they pledged $50 million towards housing. Apple has billions. I think they have 100 or 200 billion dollars in cash. So they don't need to take out a loan if they want to build a new headquarters or if they want to get some low income housing or something like that. So ideally, I think that everyone should be on a fair playing field when it comes to real estate. I don't make the rules. Let's continue.
Seen in the Green Street property report is that asset values have basically bottomed. They've begun to rise a little bit. We've also went out and deployed more than $15 billion in real estate. And so we're in that process that feels like the
$15 billion in real estate. I can bet you that a lot of that was not commercial. The commercial real estate is an entirely different market. And like I was saying, those have bifurcated a long time ago. That has to do with working from home, pandemic conditions, and a whole thing. He might reveal it, but my guess is that at least 75% of that is going to be in residential or large apartments.
The global financial crisis. I would say, as an exception, by the way, the office market is going to take longer to heal because of the big vacancies. But if you went back then, what we saw was we deployed a lot of capital after the crisis, and then markets start to come back and you exit. So it takes a little bit of time, but certainly cost of capital coming down. Borrowing costs have come down a bunch in real estate. If you were borrowing back in the fall, it would have cost you maybe 8% for a real estate loan. Today, maybe less than 6%. 10-year treasuries have come down. The CMBS market's reopened. So we just view this as a process. It takes a bit of time, but the healing has begun. And with that,
I don't know why he's saying the word healing. In my opinion, that's a little bit of a strange thing to say.
See more transaction activity, certainly as you get later in this year and into next year. So it doesn't happen overnight, but there are some positive signs for sure.
How do you think about this as it relates to interest rates? Obviously, the market is still expecting one, if not two, rate cuts this year. How would that start to unlock activity? And do you even think we get that?
If you're turning 65 or beyond, you're going to want to watch
this. Sorry about that.
There are a lot of people today that are medical.
Well, I think the Fed's medicine is working. I think when we look at our portfolio companies every quarter, we have several hundred of them. We ask them questions like, how difficult is it to hire workers? And this quarter in Q2, they said it was the least difficult it's been since the first quarter of 2021. So the labor market is cooling. We asked about, what do you think wages are going to be a year from today? And the CEO said they think it'll be up 3.25%. That's the lowest prediction from them that, again, we've had in a number of years. That's very positive. And then when you look at shelter.
It's interesting that he said that it's positive that it's the lowest prediction of wage increases in years. To me, that's not a good sign. If the average person is only making 3.8% more next year, well, what have interest rates done? Our purchasing power as consumers, I believe, is being eroded. And that's the opposite.
Costs, which are the biggest component of CPI, the data we see on the ground with apartment or single family rents are materially lower than what's in the government data. So that should come down. So it won't happen necessarily in a straight line, but I think there are a lot of things pointing to the Fed being effective here, that inflation's coming down, and that will give them air cover to cut once or twice this year. And for markets, it's very helpful. As you know, when you're raising the cost of capital, and they took cost of capital from 0 to 5.5%, that really impacts markets. That's beginning to change. And that's the reason why the bank CEOs have been on the last week talking about healthier capital markets, the early.
So just the fact that they haven't raised rates is actually a big deal, and they're actually talking about cutting rates. That if they cut rates in September and maybe once more this year, all of that inventory there is that huge inventory will just get sucked up by a bunch of people. So that's something to keep your eyes on. There's kind of this magic moment of when rates start to go down before everybody gets that idea of, oh wait, I need to invest in real estate. And that's the ideal time to buy. So I think that next spring is going to be a massive buying opportunity. That depends entirely upon the political situation, which I said, there's a number of factors which could affect that either positively or negatively, but most likely next spring is going to be another real estate boom.
Stage of this recovery in capital markets, that's obviously quite positive for our business.
John, when you think about the second half of the year, it's interesting. The second quarter, you are on track here. You increased your pace of investing to the point that you reached the highest levels in 2 years. But what does the second half bring with so much political and geopolitical risk?
Let's hear this.
We tend not to focus on those things in the short term because we want to be long-term investors. And so if there's uncertainty in the world and it results in better opportunity to invest capital, that's what we want to do. I mean, part of the reason
So, this is the same thing as stocks. Look, for us, normal people, we are all in on a house, right? But a giant company like this, if they have X amount of money to deploy, maybe they do, he just said we've had record buying. That does not mean that they can't buy again and average down, so to speak. If the housing crisis happens and it goes down 20, 30% or even 10%, like this other person said in pandemic boom towns, they will still have capital to deploy. So it's a little bit different if you're how big of a stack of money you're dealing with.
See us deploying.
And just as a note, all of this, if not most of this, I don't want to say all, a lot of this risk can be mitigated by simply buying something that you can remodel. A house's value, a new kitchen, new bathrooms, new flooring, new paint, and modern appliances is actually worth, I would say, maybe like a third of the house's entire value. So, if they're saying, oh, it's going to go down 15% or whatever, just get something that needs a new kitchen and a new bathroom, and then just pay yourself that difference between those.
This much capital is because we're investing here sort of ahead of that all clear sign before rates come down. And so when I look at our deal pipeline, be it in private equity, real estate, our growth business, infrastructure, secondaries, it's picking up. I talked about last quarter a bit of the briefcase indicator, and every weekend looking at the investment committee memos, they continue to be coming. It feels like deal activity will pick up. Not a surprise as the equity markets are stronger, debt cost of capital's come down. So I think it will be a pretty good environment. It'll continue to get better. Inflation coming down is just so important to help really grease the system and have transaction activity pick up.
Beyond the macro story here, there's a lot of political rhetoric out there that could significantly impact your business, starting with the rent caps proposed by the Biden administration in recent days. How do you see that?
I don't know if they're going to mention this, but I did in a previous video. Biden proposed a rent cap of 5% on apartment buildings with 50 or more units. So right now, currently, it's 10%. So he's going to cut that in half. It was 50 million, I believe it was 50 million units that actually applied to this. And ultimately, that'll give buyers more buying power. Over the next X number of years, you can calculate it compounding, but that would theoretically help consumers.
As impacting the property market if that were to come to light?
Well, I think getting support for something like that at the federal level would not be easy. And the reason is because these policies of rent regulation, unfortunately, have not been successful. We should start by saying there is a housing affordability crisis in the country, and I understand why elected officials want to try to do something. The challenge is if you have a shortage of something, and you decide to freeze the price of it, it doesn't solve the underlying problem.
Yeah, so he's absolutely correct here. We have a supply and a demand issue right now. And you know what it is? We do not have enough supply of houses. I addressed this in a previous video. 50% of land on the west of the Mississippi is owned by the federal government. Until that changes, we will always be in a supply crunch. And it's the same thing with immigration. This is not pro or anti-immigration. This is simply to say that if you let millions of people come in, or, it doesn't have to be immigration. It can be if you have a baby boom, right? So the point is, if you have millions of extra people who are searching for houses, then it'll obviously shoot housing up.
If you look in
And just as a last note, that will happen more so in states that are wherever this influx of people are coming from.
New York and San Francisco, where we've had rent control for decades, those are the places that have the most acute shortage of housing, because once you freeze the price of it, you tend to get a lot less supply. People invest a lot less in the existing property stock also. And so what's the challenge? The challenge is we are not building enough homes. If you went back to when they first started collecting data on housing construction in 1959, we were building 20% more housing than we are today. Back then, the U.S. population was about half of what it is today.
Wow. We were building 20% more houses in 1950 than we are today. That is astounding. With half the population? I did not know that. That is amazing. And the other thing is we're building bigger houses now because of all the rules and regulations and taxes and fees. You can't build a small house anymore. Most houses, the average is 2,000 square feet that's being built. So we're building 20% less houses, and they're bigger houses, which means they're going to cost more. So this is, we're having family size has just absolutely shrunk since the 1950s, and house sizes have absolutely exploded. What I would love to see is the amount of square foot per person per average in the United States, right? So I'm just going to do some rough numbers, but let's say we have 100 million houses for ease, and I don't know what we have now, maybe 360, 380 million people, and if they're 1,000 square feet apiece, that means we have 1 billion square feet of housing for 300 and let's say 60 million people. That's going to be 300 square foot per person. I might have got that math a little wrong, but you could sit and figure out exactly how many square feet we have per person over time and graph this. I may actually try to figure that out and put it in a graph. I think that would make a wonderful video.
Today. And this has really been the story since the financial crisis. So we need to look at zoning, regulation, density, costs. We need to do everything possible to stimulate new supply. And unfortunately, if you try to freeze the price of housing, you're going to get the exact opposite. That's what happened in a few cities. It's certainly what's happened in European cities with rent regulation. I understand the goal. I just think the way to get there is very different.
Well, what is the way to?
No, that's a really great point, because everything is a supply and a demand, right? And so if this side's going to be the supply and this side is going to be the demand, if you say, okay, we are now going to curb supply, and you expect demand to come up, well, the other way to do that would be to increase supply, and that way demand would go down. So if you want to stimulate your economy and have more places to live and have housing be cheaper, you want more supply instead of less demand. So I actually think mostly of what he's saying here is spot on. He's very knowledgeable.
Get there. Isn't the rent still too damn high, and it's becoming a bipartisan issue?
The rent, I don't know if you've seen that, but that's a classic meme. The rent is too damn high. Oh man, I'm so glad she said that. That's great. I wonder what happened to that guy.
Really, even J.D. Vance brought it up during the course of the Republican National Convention. What would be the fix?
I didn't watch that.
The fix is more supply. That's the way the capitalistic system works. If we delivered a lot more homes, you look at housing construction in California relative to Texas, and you see what happens when you can add more supply more reasonably. I think we really need to look at the state, city, federal level on how to incentivize new construction. How do we make that a national goal so more people have a shot to buy homes? There are more apartments being built. We've seen in the apartment market in the US this year, because a bunch of new supply has come on, rental growth has been much lower than it's been in past years, below inflationary levels. Supply demand works. We just need more supply of housing. I think if we make it a goal to add more supply, that'll happen.
Beyond the rent story, there's also a large story around trade, both coming out of the Biden White House as well.
Okay, I think they're kind of moving on now. But I think that was actually really informative. This guy, he has a good eye on the real estate market, and he says something that I think is spot on. More supply. I could think of a lot of different ways in which we could do more supply. I rave about this all the time. It's $60,000 to put a shovel in the ground in my county. Okay? Maybe, just maybe, if we're in a crisis, they should lower it to, I don't know, 50,000 or maybe 40,000 or maybe zero. Or, here's another thing they could do. How about all unpermitted ADUs are forgiven? Right? Just bring it up to code, and then you don't have to pay all those taxes and fees. I don't know how many unpermitted places there are in California, but there are a lot. And while I have mixed feelings about overregulation, one thing that would be good is if you get things permitted, then it would be better for the rental market, because a lot of unpermitted units are being rented, and the landlords have a lot of power over their rentees, basically. So that would be another thing. I mean, you can free up federal lands. You could get rid of taxes on land sales. You could get rid of land tax. There's so many different things that you could do. So I don't even think they're serious about this. California is half of the nation's homeless, and we're building tiny homes. We're not even building enough homes for these people. So I think that whoever wins the presidential race, and in general California, just needs to be thinking about more supply for houses. Okay, so I'm going to end this video here. If you have any questions or comments or videos that you'd like to see, all my information is below. Despite all of this somewhat scary news, there's a house out there that's perfect for you. And in another video, which I'm going to do today, I'm going to show you exactly where and when and how to negotiate to get the maximum amount off. So you can just do the math and say, there's X amount of geopolitical risk, house prices might come down in 10, 15, 20%, maybe more. Let's figure out a strategy in how to counteract that. So these are things that I love figuring out, and if you'd like to have a conversation about it, feel free to reach out. All right, thank you much. Have a good day.